Welcome back to the channel, guys, and this is going to be our last video about the confluence of different indicators and key levels when you are trading. We've been looking at the pin bar and engulfing, coupled with other technical analysis tools and indicators to see how we get opportunities to enter the market. And this is going to be the, let's call it the holy grail. So these are the four confluence factors that when you have any of the three, you have a high probability setups. So a high probability setup is basically one setup you're going to get, and you try to target at least a 1 to 4, 1 to 5, 1 to 3 risk to reward ratio. So without wasting any time, let's start right away. So what do I mean by the four confluence factors? These are the four confluence factors: trend, key level, which is support and resistance or demand and supply. The third one is a signal, which could be a pin bar, engulfing, or inside bar candle. The fourth one is going to be the Fibonacci retracement. So if you have any of these three, you have yourself a high probability setup. So let's start right away. We are using gold USD as our example. We try as much as possible to use different pairs when we are doing this video, so that you can feel confident when you're watching them that the analysis is authentic. We use normally any pair we could find on the market. So today we're using gold USD as our example, and the analysis is not on one day, it's in a couple of different days all over where we'll find such confirmations that we're talking about. So let's jump right into it, guys. We can see here that we had entered a downward trend from all this bullish impulse move to the upward side. It broke and retested at the supply zone right there, and we saw an impulse move to the downward side that created a new low and a change of character of the market. So price pushed back and came back into the supply zone to try and create new opportunities to move to the downward side. And again, there's a support which was created, as you can see here. Support broken and retested above, then the support was broken to the downward side. Now this was a confirmation that we are actually going down. Now when a price does something like this, we start looking for our opportunities to enter the market as the market goes down, because we're in a downward trend. Now we want our four confluence factors, and we see if we can align at least three. So this is a structure or a key level that has been broken, and price comes back into the key level and then creates a pin bar. Now this pin bar is what is our signal. The first thing, we are in a downward trend. That is factor number one. Second thing, we have broken support and we are waiting for a retracement. So this is a key level broken. That is factor number two. And the third thing, we are waiting for our signal. So we're looking for an engulfing or a pin bar. This engulfing or this pin bar all could work in our favor. So this pin bar right here is the one we are looking at, and we are going to draw our short position here, and we try to see if we keep our stop loss there, and we try to target all the previous lows and highs. We can get a let's try to maximize the entire move of at least 1 to 3 risk to reward ratio. So it's a 3. Risk to reward ratio is 3. You risk 1, you get 3 on this pin bar. And for example, if it was this moving average and we target above the support that was broken, it could have been something like a 1 to 2. So in this scenario, the pin bar was the best entry with a good risk to reward of at least 3. Now we are going to look at other examples. How this, we are looking at a new support that has been created, which is right here. A push to the upward sides creates a support in the market, and you just keep your line there and you wait and see how the market reacts when it breaks this support. Now if we follow properly, the market broke the support and then came back and retested with a tweezer top exactly at the break of support, and an engulfing came afterwards. Now if we try to target a 1 to 3, we can always put our entry right there and keep our stop loss right there. We look for a 1 to 3 until we see a 1 to 3, and we keep our target there. Now this is a second order that has a 1 to 3 within this combination of three things: trend, which is still downward trend, break of key level and retest of that exact zone, and then a good signal, which is a pin bar, an engulfing, or an inside bar. We haven't got a chance to see somewhere where we can apply the Fibonacci, but I'm sure that's also coming. So let's try and look at the third example. After this support was created, it was holding strong here, fake breakout, and it came back in. So these are all fake breakouts, and you can see this is the major support level, and right here in our major key level, we see price coming back to that level again and again until here when it creates another opportunity to enter. So both this opportunity were good. Entering at this as your key level was okay. Let me first clear this. Entering at this as your key level of support was okay, and entering at this as your key level of support was also fine. Any you could have entered, there were two good entries. So this as a key level created a good risk to return, which is at least 1 to 2, and this engulfing as a key level created a good 1 to 2. But which of this has all the combination of factors is this one. That's why we have labeled this. It has a rejection on the trend line, it is below the support, and it has a good pin bar as our entry signal. So this was a good order. We can open a sell position and keep our stop loss a little bit near there, and we try to target a 1 to 3, which could have been there, a 1 to 3, but just at the close of this red candle would have been a 1 to 2.5. So 2.5, not bad, but it's not 1 to 3, but still 2.5 is really good in the market. Now after this support was created, the market tried to hold the support for a couple of days. I think it was 1 or 2 days, and then it was broken and retested. Now here is another confluence of all the factors: break of support, rejection of the 21-day moving average, which is the one we are using on our gold 1-hour chart, and again we have an engulfing that rejects the 21-day moving average. This is a combination of a lot, whereby you just open your position and try to target at least there was a target of 1 to 2 only. So on average, if we look into all the setups we are looking at, they are always a 1 to 2 is at least the most probable target you can target. So keep in mind, if you're targeting, you can go for 1 to 2, and 1 to 3 or 1 to 4, 5 will take some couple of days to hit the target. So it could be something like a 4 to 5 days before you hit that 1 to 3, 1 to 6 risk reward. So if you're patient enough and you apply some good money management, you can always hit that 1 to 5 and 1 to 6 after a certain days, if you get a confirmed trend to follow. So thanks for watching, guys. That was our video about the 4 confluence factors that if you find any of these 3, you will always have a high probability setup. Just a recap: first thing, always confirm that you are in a trend. Always confirm that you are in a trend, downward trend or upward trend. First confirm that a trend is in play. After that, look for your key levels, which is support and resistance, and wait. If it's an upward trend, wait until the resistance is broken and wait for price to come back to that exact zone that was broken. Look at how price reacts when it comes back to that zone. If you get a good entry right there, a pin bar, an engulfing candle, an inside back candle, that is your cue to enter the market. Thanks for watching, guys, and keep it up.